Okay. That was from the barbecue we had last year, for those that were there. So we're going to start the presentation because we have a lot of information to get through. So still plenty of food, I hope, and cookies over here. What we have on your table while you're still eating, you have a notes page, so you can take notes for yourself, take it home. Things to do. We try to encourage people to try to find 3 things that you can do with your own finances and so on. So we're going to start the presentation. No. Okay. We don't want to watch that again. Okay. This is our semi-annual financial focus webinar. Webinar. It says webinar on there. Seminar. Here's a disclosure saying that whatever information we give you, please see a CPA and a lawyer before you take any action. This is just informational purposes only. Uh-oh. And did I do that right? Okay, disclose. Okay. Hang on. I got to get this right. Okay. 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 I did the disclosures. Okay, so today I'm going to do, for my part, it's going to be just odds and ends, hot topics, and so on. And then Daniel's going to talk about last year. You all were so impressed with your portfolios and how everything did in the economy. And we're going to, sorry, but we're going to rehash that a little bit. So it's going to be a little painful. But then hopefully Jaimee will give you a little bit more a light in that it'll be more enjoyable to pay attention, and hopefully we have some hope. Okay, on your table here we have your survey also, and I'd like everybody to grab that survey. I know you're eating, so don't get lasagna on it. And so we're going to ask for your opinion, and then we're also in the middle of the page there. We get a lot of calls from all of you asking, who's a good accountant? Who's a good plumber? Who's a good roofer? Seriously, who do you call? It's hard to find out. And so we know some from our experiences, but we thought we'd make it more official and reaching out to you folks that if you know somebody that you really like, a hairdresser, auto mechanic, write their name, the business down, and then why you like that, and then we can compile it. We're not recommending them, but we can say other people have found that these are reputable people because we may not know them. If you're a client of ours and you're one of these, and we know you, then we refer business to you that way too. So if you have people, please, and you don't have to just wait for this seminar, you can just let us know. You say, hey, we know a great person that knows that's a plumber or whatever it is. And so we're going to make that, and then Charity will compile a list So then when if you call us and you ask us, then we can see if we have somebody we can recommend. So that's just another service we're trying to offer for people, because it's kind of a tough world out there, and there's a lot of people you don't want to trust and can't trust. And so please help us out there with that. Okay, this is a odd part that just got thrown in here. We felt that we should talk about one thing that's important that a lot of people are not doing, and we're talking about umbrella insurance. Umbrella insurance, you have your homeowner's insurance, you have your auto insurance, but there's some gaps between those two, and an umbrella policy just kind of covers everything in between and over higher limits. So if you're in a car wreck, it doesn't just go to the $500,000 limit, it can go to the $1 million or $2 million limit. So if you need help with that, we don't sell it, but we can help you with that decision, and we can help you get more protection. At your age, you don't have teenage drivers. When I had teenage drivers, the umbrella insurance gets very expensive. But when you don't have No, Jaimee wasn't that bad of a driver, but and these were, I had girls. When you have boys, watch out. So Jaimee's gonna be in for a shock when her two boys get to driving age, but by then they'll probably be autonomous driving vehicles anyway, so we won't have to worry about that. Wow. So be aware, look at that, ask us questions about umbrella insurance. We've had a couple tragic situations when somebody caused an accident and it kind of devastated their finances, and so it's unnecessary. So that's just one minor thing we just wanted to share with you. Next, we saw the video, here's the barbecue, just want to throw that in here. If you got calendars from that, on June 10th is the barbecue date. We put a little sticker on there for you so you remember that, okay? Okay, this is the fun part. Charles Schwab and TD Ameritrade have merged. It's been coming up on 2 years now. So what's happening is behind the scenes, pretty much everything is Charles Schwab. If you're needing CDs, if you're wanting money markets, if we're buying stock, it's on the platform under Schwab. So you don't see that, but your name, what you see are the statements that say TD Ameritrade. On Labor Day weekend is the date that they're gonna switch your account from saying Charles Schwab over to TD Ameritrade. Oh, I'm sorry, yeah, the other way, yeah, it's gonna be, sorry. I'm getting old. Anyway, yeah, so it's gonna say Charles Schwab. And that's the date we convert over with our Morningstar software. We'll be converting that over and all kinds of things. You are gonna get a new account number and you're gonna have a new login. And that's what our whole team will be, all hands on deck, helping you get the new account logged in, helping you out with new passwords and everything else like that. But besides that, you won't need to sign, in most cases, you will not need to sign new paperwork. You won't need to sign new forms and everything like that. So we will be there, but Labor Day weekend is the date that it will actually convert over to Charles Schwab, okay? And if you have questions, write it down, ask us, but we'll help you. We have classes. Charles Schwab is doing an amazing job of just keeping us informed on how this transfer happens. Janet and I have been through 4 of these, going way back with Jack White to Waterhouse, and Waterhouse to Ameritrade, Ameritrade to TD Ameritrade. So Janet and I have been through 4 of these. They've all been pretty rough. Charles Schwab is a very large company, and there are 4,000 advisors like us that are getting converted over. They don't want us to be upset, and you guys upset, and leaving and going to Fidelity or someplace else. So they're making sure that everything is going to go smooth. They have hundreds and hundreds of people working on this, so I'm confident that the merger will go well. Okay. Other news is Nathan. Wave your hand. There's Nathan. He's the new guy. He's the new guy, so give him a hard time. He is an advisor, like Jaimee and I are the key advisors meeting clients, and then Daniel is an advisor that helps more with the trading, and Jessica will be helping as well. And Jessica's back at the office manning. Somebody has to man the store, so she got the short straw today. And so Nathan worked at Northwest Mutual, has some experience, but he's never had experience in the fee-only fiduciary advice area. He's been in a few meetings with you folks, and he loves it because he goes, I'm not selling anything. I'm just giving advice, which is pretty cool because he's just so used to sell. What are you going to sell? And we don't do that in our business. So welcome, Nathan. Be kind to him, but he'll be here to help us out. Take the load off of Jaimee and I, which has been quite a bit because we're just the people that are meeting most of you face-to-face. Daniel meets a lot of people, too, as well. So since we hired Nathan, what happened is we had to push people around and make an office for Nathan. So guess what? Who got the short straw on that one was my wife. So my wife got a new office, and that is my office. So there's me, there's Janet. We're in this office about the size of your closet. Not a walk-in closet, just a closet. So we don't have any room anymore in our office. It's worked great for the last 23 years for us, and so we've come to the conclusion that we do need to make some changes. So what we've done is we've made an offer for the property just to the north of us, which is where it used to be Buckhorn Coffee. It's this dilapidated building that's been there forever. You've been there for a long time. It was Mark Coffey's place, Coffee Realty, way back in 1990s. Yeah, Desty knows. A lot of you probably know that. And so what we've done is we're purchasing that property. We're going to build a new building, a 2-story. The second story we're going to rent out. Our office will be on the main floor. We're going to have elevators, all new, wonderful things. This building we're in, it was built in 1954. We've ran out of baling wire and duct tape and everything else to keep this thing together. And you've been here, you've seen cracks in the wall. We've taped everything together. We're trying to fix it. And after a while, you just kind of have to give up and let somebody else take over, and we move on. So we'll be building a new building. Some cool things that we're working on, too. We got like a coffee bar. We're going to be putting a drive-through window that if you have a document and you're just like in your bathrobe and you don't want to come into the office, whatever, or whatever it is, or you're sick, that you can just drive in, push a button, we'll be there, and we can pass documents or paperwork or eggs or whatever else you want. We're going to have more larger conference rooms. We only have one large conference room, and sometimes we need 2 at the same time. More parking. We're also looking at doing safekeeping boxes, which is not a safety deposit box, but a safekeeping box. They look the same, but we're going to just offer, like if you have some documents you want to store, you can come in working hours. You don't have to sign anything. You'll just have a key, come in, take it. And that'll be a free offer that we're looking at doing too. We'll have, hopefully, a basement. We're waiting for the engineers to let us know if we can put a basement in. If that's the case, these meetings will be all in the basement, and our Christmas party, too. So we're not going to be all crammed in like this anymore. So that's the exciting news for what's going on with ElderAdo Financial. And so, let's see here. What's the next? Okay. So, you all got statements last year. Were they fun to look at? Okay. So I just talked to a client earlier this week. They gave me this idea. I'm going to show a short video. It's a video from the movie Roxanne with Steve Martin and Daryl Hannah. And Steve Martin goes and gets a newspaper. Well, when he reads the newspaper, see if this is how you felt when you got your statements. Here's the newspaper. He paid to put it back. He didn't throw it on the ground. He wanted to just pay. So did you feel like that? We understand how you felt. We've been through this many, many times. I forget how many recessions and how many corrections I've been through myself, but we understand that. So what we're going to do is Daniel's going to go through. Hopefully that you won't feel like this after the presentation here, but Daniel's going to go ahead and tell us what happened last year, what we did, and then looking forward, and then Jaimee will finish us up. So here's Daniel.
All right, can you guys hear me okay? All right, good. So here's the deal. I got good news and I got bad news. The bad news is that you're going to have to listen to me for the next 20 to 30 minutes. The good news is that Colorado legalized psychedelics during the midterm elections, so that should kind of help start taking the edge off. I did talk to the chef at Padres. There are mushrooms in the veggie lasagna, so that should start kicking in here in a couple minutes. Okay. So I'm going to talk about the stock market. I'm going to talk about the bond market. We're going to talk about last year. I'm going to help set the stage for Jaimee to come in right behind me and to kind of explain our game plan going into 2023. We're going to talk about just kind of what did a normal blended portfolio do. We're going to talk about some changes we've made, and then we're going to finish up with the Federal Reserve and some inflation information. So just to start off, here's an interesting little factoid. This is a chart showing you the M2 money supply. M2 money supply measures how much money is in our economy between checking accounts, savings accounts, money markets, or anything that's considered a cash equivalent. Now, for the first time in over 60 years, this is going back to 1959, we had a decrease in the M2 money supply. Every year since 1959, we have always, to some degree, had some crazy, or not crazy, but some kind of increase in the money that was printed and injected into our economy. If you fast forward to 2020, we all remember COVID, right? We saw a 25% increase in the money supply, the single largest increase since 1959. In 2021, we added a little bit more, clocking in at 12%. I wasn't able to update this chart sooner, but this is going as of November of last year. We were down 0.6%. Now that I have December's numbers, we went down 1.33%. Now, the part that's really remarkable to me is that we only went down 1.3% given the amount of damage that was caused. This is just to kind of help give you guys a visual of what happened during 2020 and 2021. You know, we were doing fine, and then we had the pandemic. We saw the Federal Reserve basically take two bazookas, stuffed them with cash, and blasted our financial system with all this liquidity, which explains the V-shaped recovery. We got past the 2020 election, got some pre-election jitters right there. And then going into 2021, it was hunky-dory from there. Now, to kind of help set the stage for 2022, you guys have to remember the Federal Reserve had lowered interest rates to the floor. CDs, money markets, what are those, right? They weren't paying anything at all. And we had a lot of concern that inflation was going to be a problem. We knew that inflation was going to be coming around the pike. We just had to wait and see when the numbers came out. So in preparation to that, we added Treasury inflation-protected securities, also known as inflation bonds. They've been paying some decent income for the last couple years. And then we also knew because we were going to have inflation, the Federal Reserve had to start raising the interest rates to fight the inflation. And so when you raise interest rates, not only is the stock market not going to like that, but also the bond market. You guys remember last year, Jaimee shared that bond prices and interest rates have this, what we call the fixed income seesaw. They have this inverse relationship. As interest rates drop, bond prices go up. As interest rates go up, bond prices drop. And if I do this fast enough, maybe I'll take off and fly. So knowing that the interest rates were going to have to go up to help fight the inflation, we weren't investing in 10, 20, or 30 years, or we tried to reduce our exposure to those. We instead invested in short-term treasury bond, or short-term investment grade I'm totally losing track of what I'm saying. Yeah, investment grade short-term bonds. So instead of investing in the 10, the 20, the 30-year treasuries, we were trying to keep the time frame short, 0 to 5 years. And like I said, remember we were in a low interest rate environment. Now, before I continue, Jim has stories, Jaimee has stories, I have stories, and soon enough, Jessica and Nathan will have stories of their own. Every time we go through some crazy time in the market when everything is crashing, we always run into investors who somehow are able to perfectly time the bottom. It was like this during COVID. We had, there were a handful of investors that sold at the very bottom of 2008, .com, all that jazz, and then obviously COVID. What I'm starting to realize is that not only are investors able to perfectly time the bottom and they capitulate and they get despondent, but somehow they're able to perfectly time the top as well. I had a handful of clients get on my case because their accounts weren't performing as well as the stock market, and I'm trying to keep explaining to them, we're not putting all your money in the S&P 500, that would be suicide. It's a mix of stocks and bonds and everything else, and we're trying to cut back risk, and we're trying to get some more income, and we're very concerned that at some point this party's going to end. And these clients kept getting on my case, I want more risk, and I'm like, no, you don't. They're like, we want more risk, and I'm like, are you sure? Because I don't think that's a good idea. And then they said, we want more risk, and I'm like, all right, your money. So last year in 2022, the S&P 500 wasn't the worst performance year we've ever had. In 2022, we were down the S&P fell 18.1%. We did basically half of what the great financial crisis was. And because we're Americans and because we like labeling everything, we're calling last year the Great Inflation. But it wasn't just the stock market solely responsible for causing all this pain last year. It was also the bond market. Now, to kind of help put the whole thing in perspective, what happened to the bond market last year? The 10-year Treasury bond, the United States Treasury bond, and I want you all to look at the air quotes I'm about to put in the sky, all right? The safest investment you could ever make had its worst performance since 1788. Now, for those of us who are history buffs, you would probably remember that George Washington was president of these United States. So we purposely try to stay away from the longer duration, 10-year, 20-year investments. We try to keep it short, try to keep things as little volatility as possible. So what this chart is showing you, I know it's really busy, but just hang in there. This is showing you the annual performance, and this is kind of remarkable, going back to 1928, so almost 100 years ago. This is the industry standard 60-40 portfolio, 60% stocks, 40% bonds. And it's just outlining, 60% allocated to the S&P 500 index and then 40% allocated to the 10-year Treasury. What we experienced last year in 2022, just of itself, was very rare. Almost 100, in the last almost 100 years, there have only been 4 times in history where both stocks and bonds went down in the same year. 2018 during the China trade war with Donald Trump. 1969, I don't know what to blame that on, so I just say Woodstock. 1941, obviously World War II, and then 1931, obviously the Great Depression. So this portfolio went down about 18%, not the worst performance. That was going back to 1931 when it went down 27.3%. Moral of the story, given the low interest rate environment we were in, we were genuinely trying to make the best of the worst possible situation. So going into 2022, if you remember that chart where it was 2020 to 2021, market was going up. This is the start of 2022. This is going into January. At the beginning of the year, the markets had already started to price in interest rate hikes. They were basically trying to, and the markets are forward thinking, and we've told you this a million times. Markets are looking 6 months to a year in advance. So even though by this time we might not have been in a recession, we had fully recovered from COVID, the markets were trying to price that in. So the S&P started to drop a little bit, and then our friend Vladimir Putin didn't make things any better by invading Ukraine, creating an energy crisis in Western Europe, and then the US and the rest of the NATO allies threw the economic sanction book at Russia. McDonald's, I think if I remember correctly, lost 10% of their global revenue because of the sanctions we put on Russia. Starbucks, Coca-Cola, Rolls-Royce, Rolex, British Petroleum, Shell, all those companies. So the markets had already started to price that in, and then we had some craziness because of the Ukraine war. Now fast forward into spring and going into summer, the Federal Reserve finally started raising interest rates. We were sitting here thinking, okay, they're going to have to be very aggressive. We're probably going to see like 0.75% or 1% interest rate hike. All we got was a measly 0.25% to start. So then we fast forward going into April, they bumped it up from 0.25% to 0.5%, and then going into June, they bumped it up going to 0.75%. So altogether, between January and June to going into July, the Federal Reserve had only raised interest rates 1.5%. One question that we have gotten asked a lot was, Daniel, you knew the bond market was going to get hit. You also knew that interest rates were going to go up. Why did it take so long for us to switch out of short-term bonds going into money markets? There are two very good answers to that. Reason number one, the Federal Reserve had only raised interest rates like 1.5%, and the money markets by this time was only paying 1.25%. So the interest rates were not high enough for us to justify the move over. So that's reason number one. Reason number two, I will sum up with one word.
Here we go. Pivot. 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 Shut up. Shut up. Shut up. Okay, I don't think it's going to pivot anymore. You think?
So let's just take a quick assessment of what has happened by this time in the middle of the year last year. Turmoil in the stock market, turmoil in the bond market, energy crisis and war in Western Europe, or Ukraine/Western Europe. And one of the things that I wanted to make sure we were not going to miss was the possibility that the Federal Reserve would pivot on monetary policy, where they are hawkish and they're really aggressive, and they're raising interest rates, and they're very aggressive with the monetary policy, to pivoting to becoming more dovish, meaning that they stop raising interest rates, they're more laxed on monetary policy. Now, technically that came into fruition when the FOMC, or the Federal Reserve's Open Market Committee meeting minutes, try saying that 20 times fast, the FOMC meeting minutes were released in early July. Within those meeting minutes, the Federal Reserve had indicated that, you know what, we raised interest rates quite a bit, so we're probably going to take a pause, kind of let the data come in, and then make appropriate adjustments after that. Once that FOMC meeting was released to the general public, we saw a 16% increase in the S&P. Now, unfortunately, that party was short-lived when we had hotter than expected inflation numbers going into the fall months. The Federal Reserve, basically their hand was finally forced to become more aggressive than what they should have been at the very start, and they started raising interest rates 0.75% at a time. So with the 1% increase here, and then the 0.75% increase here, the money markets finally started paying enough for us to justify. We got out of short-term bonds, got into money markets, and I think the Schwab Value Advantage is paying, I think, 4.4%, somewhere give or take. There was a client in Arizona. I called her the day before the midterm elections, and she picks up the phone and she goes, Daniel, what good financial news do you have for me? And I said, the midterms are ending tomorrow. So midterm elections, we saw the political gridlock from one degree to another. Markets had a nice little recovery there, and then we had a little end of the year volatility. We had another 0.75% increase going into November, and then the Federal Reserve ended last year with a 0.5% increase. Last Wednesday, the Federal Reserve raised interest rates again, but they only raised them 0.25%. One of the reasons why the markets have been up this year, I'm trying not to steal too much of Jaimee's thunder, one of the reasons that the market is up this year is because the Fed is finally kind of starting to relax a little bit on the interest rates and the monetary policy. And then this is just going into some of the changes we've made. Money market utilization, as I mentioned, the money market's paying about 4.4%. We were recommending CDs. We are now kind of starting to slow that down. When the Fed got really aggressive with the rate hikes, the interest rates on the CDs were really competitive, and so it was just taking advantage of that opportunity. We have since started to slow that down. The rates are not as competitive. And then another thing that we did is we started incorporating, before the end of the year, consumer staple stocks, or basically it's grocery store stuff. You know, your Kroger's, your Procter & Gamble's, your toilet paper, you know, your $8 carton of eggs, like insane stuff. So typically in a recessionary period, going into 2023, you know, we wouldn't be surprised if we saw at least a mild recession, but consumer staples tend to perform well during those times. Now, before I get out of your hair and pass it off to Jaimee, there's two more things I want to cover. The consumer price index, I hate it. I hate the CPI. The consumer price index is the government's attempt to take a basket of assets and jumble it all together and perform some mathematical wizardry and to come up with some idea of what the average American is being hit with inflation. Now, one of the big reasons why I hate it so much is because the calculation, the mathematical calculation that gives us the consumer price index has been changed twice before in the past, okay? The blue line represents the CPI index as if it was calculated back in the 1980s. The red line represents the CPI index as it was as it's been calculated for like the last 20, 30, 40 years. So typically, if the CPI is coming in at 6.5% right now, we usually take that number, double it, maybe add a little bit on top, and that's kind of a more, in our opinion, our professional opinion, a more accurate reflection of what inflation actually is. My engineers, my mathematicians are going to love this part. There's a very important lesson that we can learn right here, okay? If there's anything you get from me, please let it be this. If you do not like the numbers, change the math. So a lot of you cheated on your math homework. I knew it. Mark Twain once said that there are three kinds of lies: lies, damned lies, and statistics. For the first time, or for the third time in its history, the Bureau of Labor Statistics changed how the CPI calculation was, or they changed the math on the CPI calculation again. And I quote, starting with January 2023 data, the Bureau of Labor Statistics plans to update weights annually on the Consumer Price Index based on a single calendar year of data using consumer expenditure data from 2021. This reflects a change of prior practice, updating weights biannually, yada, yada, yada. Okay, here's the deal. I could just throw a bunch of Greek letters at you and tell you that it's math, but I'm not going to do that. Long story short, we think that not only is the CPI number for the last several months already on a downtrend, but we also think that it's going to continue, but at a more accelerated rate, okay? More or less, what I think is going to happen, and I could be wrong, but this is just my thinking, the government more or less is trying to incentivize the Federal Reserve to stop interest rate hikes sooner rather than later. I do expect this downtrend in the consumer price index, or the CPI, to continue at a more accelerated rate. I don't think it's going to have like a 2, 3, 4, 5% drop. If that happened, that'd be remarkable. Someone's playing their own track in front of me. Daniel is mad. No, I'm totally kidding. Okay. So, sorry, where was I? Okay, so CPI index, I do expect it to continue to come down. I do expect it to come down at a more accelerated rate. I do not expect a crash. If that happened, the guys at the Bureau of Labor Statistics have their work cut out for them. Here's the deal. Next, what is it today? What is today? Wednesday. Next Tuesday, mark your calendar, CPI day. If what I think is going to happen actually comes to fruition, do not be surprised if we start making some changes in your portfolios. Jaimee's going to talk a little bit more about that. So that's basically the moral of the story. So do not be surprised if this comes down a little bit faster than what it's been doing. And then also, if that comes to fruition next Tuesday, we're more than likely going to be making some not drastic, but we're going to be making some changes. Now, you're probably a little confused right now. Daniel, have you seen my Black Hills energy bill? Have you seen the prices at the grocery store for a carton of eggs? What do you mean inflation is coming down? Something that you should know is that 32.7% of the consumer price index is weighted towards shelter, or basically real estate, rents, mortgages, stuff like that. But even though gas and utilities and transportation and food at the home and away from home has gone up, over 1/3 of the CPI index is weighted towards real estate, okay? Now, what has real estate been doing in the last several months?
U.S. existing home sales slumped to a 2.5-year low in November as the housing market continued to be squeezed by higher mortgage rates. November sales plummeted 7.7%, the National Association of Realtors said on Wednesday. Sales have now declined for 10 straight months, the longest such stretch since 1999. The biggest impact on home sales this year? Higher mortgage rates driven by the Federal Reserve's interest rate hikes, the central bank's fastest rate hike cycle since the 1980s. The Fed is seeking to slow unacceptably high inflation by bringing down demand for everything, including housing. The average rate on a 30-year fixed-rate mortgage surged above 7% a few months ago, the highest since 2002, according to data from mortgage finance agency Freddie Mac. Though the rate retreated a bit last week, it is double what it was that time a year ago.
So, okay, they're changing the math on the CPI. More than likely, they're trying to get the inflation numbers down sooner rather than later. But the real question is, why are they all doing this? I mean, yeah, the markets like it when the interest rates don't go up, but what's the point of doing this? Simple answer. On average, the United States pays about $300 to $400 billion on the already $3.5 trillion national debt. We're going to double that this year, and more than likely, we're going to pay about $1 trillion. Now, I don't know if you guys have been paying attention, but we have a debt ceiling problem in Washington, D.C. It is a tale as old as Shakespeare, Montague, and Capulet. The Democrats want to spend all the money, the Republicans don't want to spend any of the money. So, Janet Yellen, if I remember correctly, in an open letter to Congress says that she has enough reserves at the United States Treasury to last us until about June or July of this year before the United States government starts to default on its debt, okay? I think it's going to be a little bit longer than that if you account for things like tax revenue. What I'm expecting to happen is, and the thing about the Treasury that you got to recognize is that the Congress authorizes the Treasury to issue out the debt. The Federal Reserve, that's basically the guy printing the money, prints the money, buys the treasuries out of the market, injects that cash into our financial system. That's basically, I hate to say it, it's basically how our economy has been running since 2008. So they keep raising the interest rates and they don't raise the debt ceiling, and if we hit that debt ceiling, it could start causing a lot of problems. Because of the debt ceiling, and considering the fact that we have, how much, Jim, like $23 million in the Schwab Value Advantage Money Fund, right? Yeah, somewhere around there. So knowing that there was a possible risk with the government default on its debt, I hit up a buddy of mine at Charles Schwab who works closely with the money market that we have in your guys' accounts. And I said, Mikey, you gotta be frank with me. Just humor me for a second. What happens, what are you guys doing if the government starts to default? And the way that he explained it was, one thing that Schwab is doing is that they're avoiding treasury bonds that are set to mature around the point where the government is supposed to default on its debt. So they're doing that. They're also rerouting from treasuries going more into like Ginnie Mae's, Freddie Mac's, Sallie Mae's, different agency debt that has a lot more liquidity. Now, the way that he explained it to me is, if the government doesn't do anything and they don't raise the debt ceiling and we hit that cap and the treasury bonds start to default, it's not like, the four horsemen of the apocalypse is going to come and we're all going to hell in a handbasket. What more than likely is going to happen is that it starts extremely small, like a handful of billions of dollars. And so we hit the debt, and then you have this tiny, small amount of the debt that starts to default. They don't mature, they don't get the interest paid to them or get their money back and all that jazz. So it starts really small. And then when left untreated, it gets a little bigger, little bigger, little bigger, and then a little bigger. Do you guys prefer to watch grass grow or paint dry? Time frame? I don't know. We've never defaulted on our debt before. Since the 1960s, the United States government has never not raised the debt ceiling, okay? So the way that my friend at Schwab explained it to me is that it's going to, if it does happen, it's going to start really small. And when left untreated, then it starts to get bigger and bigger, a little bit over a long period of time. Basically, what he explained to me was in order for like the money markets and CDs and all these other debt instruments to start having problems is that the contagion gets so big. It's like throwing a pebble on the west coast of Africa and it turns into a tsunami and takes out New York. But it's unlikely of that's going to happen. Now, I understand the chances of the debt default happening are very low, but I also understand that it's never zero. We're going to talk about that here in a second. One thing I want to mention before we move on. If it does happen, as it does get closer, these guys are going to do what the mainstream media do best. They just overblow it, right? So it's going to, seriously, like it's going to start really tiny, and it's going to be a handful of bonds, and then it's going to have to go for a very long time in order for there to be a lot of contagion. Now, there's also a very big reason why more than likely we are not going to see a default on the debt, okay? If the United States government does default on its debt, the stock market is going to continue to plunge because we don't like uncertainty. The cost to borrow for things like mortgages, car loans, credit cards are just going to go go parabolic because what bank wants to take on the risk? The United States credit rating is going to get downgraded, making us less competitive in the international markets. And then, of course, you got everyone's favorite third rail of American politics. 2/3 of our national debt is made up of Social Security and Medicare. Those things are going to get affected. You touch Social Security, you die. Yes. Third rail, guys, third rail. Okay, so moral of the story. Could it happen? Sure. Is it likely to happen? Not really. Should we be like running around with our hair on fire? No. More than likely they're going to figure it out because I don't know what member of Congress is going to want to deal with any of this, okay? So we have a game plan moving forward. We're watching things, and here's Jaimee.
All right, that's a fun way to come in, huh? So thanks for all being here today. And so now you heard all about last year. Which one did I do? Oh, wrong way. So Daniel, I'm not going to go through all this. This is what Daniel tried to condense in 30 minutes. Pretty dang good, huh? This is a crazy, wild roller coaster that happened last year. So we just tried to hit the main points, the big questions as much as we could. I'm not going to go through this. I just thought it was crazy to see, a lot of the main points that happened last year. So props to Daniel. But let's look forward, right? We looked in the rearview mirror. We saw what happened in 2022. So I'm going to talk through this year. What's our plan? What are we monitoring? Daniel hit on some of it, right? The debt ceiling is kind of coming in this year. So I'm going to talk through quite a few of these things and things that are relevant to your portfolios. What are we going to make changes? So January, I have a fun job. Look, doesn't January look so much nicer than last year's graph? It's 1 month, I know. So in 1 month, we never hang our hat on anything short term, but it's nice to see something heading in an upward trajectory. We're not even close to getting, where things were at the beginning of last year. But like I said, it's nice to see a little bit of positive. So if you open those January statements, you're not going to pay to throw it back in. You might be a little bit happy to see that. There's also a saying, and it's not a for sure thing, but there's the saying, right? As January goes, so goes the year. So I would like to think that if we see this in January, we'll start to see a nicer year. I'm not saying we're going to be fully recovered this year, but it's nice to see things headed this way. If you look at last year, so goes January. January was not a good month, and the year progressed. So kind of monitor and see, but it's nice to see some growth coming. I think we're still going to see quite a bit of volatility. Things aren't figured out, and I'll kind of share a few things that we're looking at. So still expect volatility, but at least for the first few months of the year. So when we're looking at economic health, there's kind of 3 categories of things that we look at. So the first one, where are we right now? So last time when we were meeting, we said, okay, we're probably in a recession. Well, historically, a recession is 2 contracting domestic products, 2 quarters of that decreasing. And it had at that point. But then as the year progressed, we're kind of in kind of things that got a little bit more positive when it comes to production. So that's our companies making profits. Are they making widgets, things like that? We have production here too. So we're to monitor where is our economy right now. We're looking at production. Are things growing? Are profits happening? And right now it's actually positive. Now we look at that. If you say that, oh, maybe the economy's in a good spot. Maybe, but there's a lot of conflicting information too. So there's also leading indicators. So there's things that happen before an economic event, right here, all this orange, that say, okay, what's to come? And the biggest one, and we've said it before, is the stock market. The stock market looks ahead to say, in 6 months, are things going to be good? Are they going to be hunky-dory, or are they going to be pretty dismal? So when the stock market started off January last year, it didn't like what it saw. And so then it started to head downward. So thus, last year, that's why it was heading down. We'll see where this year takes us. The other thing that we like to look at is consumer confidence. Are people confident that the economy is going to be doing okay? There's a few things that we look at that, and I have another slide I'll show you that kind of shows where consumer sentiment is right now. But actually, consumer sentiment, it dipped a little bit, but contrary to kind of how the gauges that I feel, a lot of people seem to be spending a lot of money and taking on a lot of debt and not saving as much, which means they think things are okay. I don't know that I quite agree with that, but it's an indicator, right? So we're having some conflicting here, right? The stock market was saying, hey, things aren't good, and they're not going to be good. Consumer confidence is saying, it might be fine. And then we look at lagging indicators, and that's some of what Daniel had been talking about, and these are starting to kind of be the bigger news items. We have interest rates, which I'll talk about more, but interest rates rising is a lagging indicator. The Federal Reserve changes the rates, and it takes a few months for them to actually ripple through an impact. And then also, I'll just call out unemployment and consumer prices inflation. That's been pretty rough, but we have unemployment too, and unemployment numbers, once again, they're lagging. The most recent ones said that unemployment's lower. However, there was, as Daniel talked through statistics and how wonderful those are, there was a number that came out for unemployment, what was it, a month or 2 ago, and come to find out, oh shoot, they did it wrong and calculated wrong, and instead of a big, gain in jobs, there was a loss. I was like, well, that's a pretty big dissonance right there. So we're kind of keeping an eye on the unemployment. It's hard to really say, is it, showing in a positive direction or not, because the statistics are off. So these are just in general. I'm not getting super into the weeds on them, but these are some things that we look at to say, hey, are we heading into a recession? Are we not? Are we in one? And it's kind of across the board. Some things say yes, some things say no. So we went to an economic talk, and the economist said the same thing. He said, well, maybe. So maybe we're in a recession, but these are things that we're monitoring to see, hey, where are we at? Where do we need to be? What do we need to change? So let me talk a little bit more in depth on some of these in a few minutes. The other thing we're monitoring there's a lot of global risks, right? We're now in a global economy. It's not just what's happening in the United States, it's what's happening in the world. Daniel touched on a few things, but there's also a few really big risks. Some of these aren't new. They're just rippling into 2023. So energy supply, right? With Ukraine and Russia fighting, and there's a whole issue with energy supply because Russia controls a lot of that. So we're seeing a crisis in that and spiking energy bills. Cost of living and inflation, I'm gonna loop those together because they're pretty close. But we're still seeing high inflation, high costs. So these are some big risks that we're taking into account when we're looking at portfolios. Oh, went too fast. This is just kind of in general, some things I said, but we're monitoring quite a few things. Some things that we know what's gonna happen, we have a game plan, said we're gonna do this and this and this. And there's some things that we're waiting and watching, like Daniel said, next week we're gonna watch and see what happens with these new inflation numbers before we make an educated decision on what do we need to change or do we need to change. But here's just a list of a few things that we're watching, some things I said. The other thing that we're keeping an eye on, because we have to be involved in what's happening. I'm not gonna share all these tech trends, but some of them are just interesting, what's coming down. Some of them are scary, some are interesting, but there's a lot of very interesting tech trends that are coming that we wanna be aware of so that we can either get you invested in it or just answer questions. There's some crazy ones like they're trying to get smell digitalized. I don't know how, not my deal. More healthcare monitoring, which could be great, right? More information to help us be healthier. But there's another crazy one that I just wanted to share with you of something that's coming down the pipes. I don't like it, but I'm sharing it with you in case you're gonna buy a new car sometime soon. So, and I've shared this with a few of you, but if you're looking to buy a newer car, there's a lot of microchips in it, right? Well, those car manufacturers want to make extra money off you. So what are they doing? They're adding subscriptions to your car. So if you want heated seats, you got to pay them a monthly subscription to have those heated seats and stuff. I know. So I'm just throwing that out there as, I hated it, and it's not there yet. Some of them are really getting into it though. So if you're planning to buy a new car, just be aware of that maybe being a factor. It's not completely out there yet, but that also might make used cars more desirable, because I don't really want to pay a subscription for my heated seats. Anyway, so I digress. There's a lot of tech trends that we're watching and monitoring just to make sure that we're informing you of what's going on. All right, so this is kind of a callback to consumer confidence. How do the kind of general population feel about where we're at? Not necessarily, where Congress or the president or anything say we're at. Where do they feel in their spending? So typically when confidence is low, we're in a recession, and usually COVID is a prime example, right? COVID happened, everybody was not confident in our economy and where things were headed, so the black line was their savings rate spiked. Everybody started saving money, and their spending, or the red, decreased. Some of that was out of fear, some of that was it's COVID and they couldn't go do anything. But then you kind of watch it progress. Look at how crazy this is right now. We are at insanely high amounts of consumer debt and very low savings rates. As an advisor, I hate this because that's just not good for anyone. You've got to have your spending and your savings at least balance out, if not more saving, right? But this is this concerns me, seeing where the spending is. But if you're looking at the economic indicators, confidence is great, maybe the economy's great. There's two sides of every kind of coin. So now we're going to get into a little bit more of here's what we're watching and here's what we're going to do about it. So the Federal Reserve, Daniel talked about it already, and this is a historical graph, shows some of that. But what do we expect the Federal Reserve to do? So as Daniel said, they've been raising rates since last year, since inflation went crazy high. They raised them to 4.5 at the end of the year. As Daniel said, they did raise them another 0.25%. And more than likely, they're going to raise them at least one or two more times, but at a 0.25% rate. So it's starting to ease. That's why the stock market's starting to feel a little bit better. But then more than likely, they're going to hit a point where they say, we're going to stop. We got to stop raising rates. Hopefully that's good enough. Hopefully inflation is calmed. And when they stop raising those interest rates, it'll likely stay steady for a while. So more than likely through the rest of the year. And when they do that, we're going to make some changes, which will be in my very next slide. But it's going to stay kind of steady for a little bit, and then eventually they're going to have to start decreasing those rates because the interest rates are pretty high right now. So how do we take advantage knowing that this is going to happen? This is a little seesaw Daniel was alluding to, so I won't re-explain it all. But this is where we've been. We've been in a place when the interest rates were at 0. There's no way they can go lower than 0, hypothetically, right? So more than likely, they're going to have to raise interest rates, which is this yields right here. If they're raising interest rates, your bond price is going to fall. We knew that was going to happen because at 0, we know they're going to have to raise. So we've been in short term. The shorter the term, the closer you are to the middle. So when the rates rise, your price isn't going to fall as much. So we knew that. We wanted to protect you by keeping it short. And thus, we also changed things to the money market, as Daniel alluded, but we've been in this short area. Then he said, hey, when the Federal Reserve pivots and they stop raising rates, there's time that we need to change it because we're not at risk anymore of the prices falling. They're more than likely going to switch over here to this one, where they're staying steady, or at some point, the yields are going to fall, or they're going to lower rates, and your bond price will rise. So it's kind of a win-win. So here's this red line, or red star. That's where we are at right now and where we've been, right? We were in short-term bonds, switched to money markets and CDs, depending on circumstance, what made sense. And it was great, right? Right now, we're still in it right now. We're earning 4.4% on a money market. That's fantastic at very low risk. But when the Federal Reserve makes some changes, we want to move with them. So we'll switch up the yield curve, get higher yields, so higher rates of return, for a little bit longer bonds. Now, when I say longer bonds, that doesn't mean your money's locked up any longer. All it means is that the mutual fund that has the bonds, or the ETF that has the bonds within them, just has some longer term bonds. So you still have great liquidity, but you're just getting a higher yield. And inevitably, when they lower the interest rates, you're going to get a price increase on those bonds too. So that's what we're looking at. We have not made the change yet because the Federal Reserve is still raising rates. So that's on the chopping block for us to do. We're getting close to making this change, but this is just so you know when you see the changes why we're doing it. The other thing Daniel started to allude to, right, we have inflation. We've been talking about it for a long time. You're probably sick of hearing tips. I'm sick of saying it. But it's been a great tool for us to use in the high inflationary environment. We've gotten to earn some really great returns on those tips. However, as Daniel said, inflation's starting to ease, probably. We're going to be watching what that new calculation says when it comes out next week. But more than likely, we're going to switch out of some of those Treasury inflation-protected securities and make some switches into some more intermediate-term bonds. Another thing that we've been really big on utilizing, and I thought it was a pretty cool announcement, ETFs, aka exchange-traded funds. Those are 30 years old. Kind of crazy to believe that it's been already 30 years since they've been out, but we're starting to utilize them even more and more. ETFs are great because they're lower expenses, and at the same time, it gives us a lot more flexibility to say when do we buy and buy in at intentional times or sell at an intentional time. Whereas a mutual fund, we don't have as much of that flexibility. So ETFs are a great tool. We don't use them completely in our portfolios because there's just some mutual funds that are just flat out better. So when a ETF comes out and it has a good proven track record and we feel okay to switch it, then we sure will switch it into an ETF. But it's pretty cool. We have a 30-year track record on these ETFs, and they're really good. They're driving down costs for you guys, which is always an amazing thing. And on the whole cost front, with the integration of Charles Schwab, there's a whole new share class for those mutual funds that we can't switch into. It's called institutional shares. And Daniel went to the conference and learned all about this. And there's a few of the mutual funds that we use that we can switch share classes into institutional. And what this basically means is your investments will have a lower fee, lower expense ratios. I think that's great. I worked at Vanguard. They're all about low expenses. We're still about low expenses here. So You'll start to see some switches into some of these institutional share classes. We haven't done it with every single mutual fund that we have yet, because we want to vet out and make sure it's not going to cause any tax headaches for you guys or any other weird issues. So when you start to see, you'll start to see some changes into that. All right, politics, everyone's favorite. This is actually a pretty cool slide, though. I know if anybody watched the State of the Union address, it's probably top of mind, but it's Biden's third year. Whether you like him or you're not, the third year of a presidential kind of term historically tends to be the best out of all 4 years. It's just how it works, and I'll tell you why, right? Because it's kind of an interesting stat. I'm not saying it's going to be 10%, by the way. This is just average. I sure hope it is. But on average, it tends to be the best out of all 4 years. And the reason is the president's been in office for 2 years. They've seen what he's done, and they kind of know what to expect. The stock markets, Daniel said it, the stock markets hate uncertainty. So they know what to expect from the president. The midterms are done. Woohoo! So no more midterms, and the election year is a whole other year away from now. So there's a lot of knowns, and there's a lot of gridlock. And the stock market loves gridlock because it knows what to expect. So this makes me pretty excited, right? Seeing historically it's a good year. That coupled with how January is going and looking at some of the economic indicators, yes, it might be bumpy, but it looks like it's going to be a whole bunch better than last year. All right. So we're kind of shifted out of some of the investment portfolio discussion. We can talk more about it if you want to. We'll do that more kind of on a one-on-one basis, but that's just kind of in general what we're looking at doing as a firm. There's a few really important things that Congress passed at the very end of last year. It's called Secure 2.0, and there's just a few important things. There's a lot of things wrapped up into it, but a few things that are most important to our clients. First of all, the new required minimum distribution age is 73. So, and that's if you were not already taking a required minimum distribution. So anybody that turns 72 this year, you get to wait a whole other year. And then there's also a plan for it to shift to 75 a few years from now. They had adjusted the required minimum distribution for inherited IRAs, and they have adjusted it and adjusted it and adjusted it. So it's constantly in flux. We're watching it. If you have one of those, just know that we're on top of it and we're monitoring the constant changes to that. But one positive thing that they did in terms of RMD is they realized Americans are living longer, so they reduced the amount you have to take out every year. Pretty nice win there. The other thing they changed was some contribution limits to retirement accounts, so you can put a little bit more in. Huge fan of that. The other two, these might be relevant to you or for your kids or your grandkids, but I want to share anyway because they're kind of cool. One is, and these last two come into play next year, so there's still some of the finer details to be ironed out. But if you have student loans and you want to contribute to a retirement plan, Congress made it a little bit easier for those that are paying student loans to get matches on their retirement accounts. I'll get into the details if you have somebody that, that it applies to, but it's a pretty cool way for the government to help encourage retirement savings. I'm a fan of savings. And then the last one, if you have a 529 plan and your kid's not going to use it, or your grandkid isn't, or you're not going to use it, there's a new thing coming in next year that you could convert some of it to a Roth IRA. So for a little bit, I was a little skeptical about the 529 plans. I had one for my kiddo. I stopped. This might make me start doing it again. So we can talk more about it, more in depth about some of these, but this is just in general, just so you're aware. They actually pass some things that I'm a fan of. All right, this is my last one. Just want to end kind of with a quick little story, put a little bit of it into perspective. Here is a client's, just a kind of snippet of the last quite a few years for one of our clients. We'll call him Jim. It's not Jim's, but I just saw him, so we're going to call him Jim. So he started right over here with about $1 million, and this green is what Jim put in, and the blue up here is the top part is where the balance of the account is. So any of this blue is growth in the account. So Jim put it in, worked for a while, then retired in around 2013 and started taking distributions. as most of you are doing or will do, right? You save the money, so you should start to take it out. But he continued to follow the plan that we had set for him, right? We set up a retirement plan. We said, okay, this is how much we can take. This is how much risk you can take to afford. And it kind of followed the plan. Didn't panic through any of the kind of downturns that have happened throughout here. I know there's even COVID in here. Didn't panic, stayed true to the plan and our recommendations. The crazy thing is, Jim has taken about $800,000 out of the account. But where is it at today? It's right at the same amount they started. How cool is that? Now, so I just wanted to share this. It's a long-term perspective, right? We're not talking a January or a 2022 or anything like that. We're talking about multiple years and just kind of staying true to, hey, here's the plan. Let's work through it. That's pretty cool. Just kind of seeing how things worked out. So that's just what I'm here to say. We shared a lot of information. We love to educate you all. That's why we do these. We really appreciate each and every one of you and getting to meet with you. But we want to see you all be successful like this. This, to me, looks pretty successful. So, in closing, thank you for being here. If on your tables you have a little survey, fill it out. Feedback, good, bad. It doesn't hurt my feelings. I like to make things better if there's anything we could do better. And then just remember, if you have any providers that you've worked with that you would love to share, I'm personally looking at getting a new roof, so I've gotten 2 really great recommendations on a roofer. So anyway, if you have any of those things that you're like, I just love working with this person, please write it down, because we would love to, we love to help in whatever capacity that is. So that's all I got for you guys. And if you have any questions or you want a meeting, put it on the forum. We'll help answer those questions, set up a meeting and whatnot. And I hope you have a wonderful day.